Welcome to the Deep Dive. Today we're digging into Union Pacific, that's UNP, a real heavyweight in North American rail.
Absolutely.
We've got an interesting article here. It's from the Motley Fool, just came out May 2nd, 2025. And it basically asks, how is this big dividend payer holding up, especially with all the trade war stuff hitting transportation?
Right. That's the big question.
Now, our mission today really is to unpack what makes Union Pacific potentially resilient here. And, what you can maybe learn from that about finding solid investments when things feel uncertain.
Yeah, and it's a critical area to watch. The transportation sector, it often acts like a barometer for the whole economy, right?
Definitely.
So trade wars, well, they throw a wrench in the works. Tariffs, supply chain chaos usually means higher costs for shipping, less stuff being moved around. That's the typical impact.
Okay, so let's paint a picture of Union Pacific itself. I'm not talking about just any railroad here.
No, not at all. They're one of the absolute biggest in North America. Their tracks, they cover like the western 2/3 of the U.S.
Wow.
And they have these really crucial connections up into Canada and down into Mexico, hitting all 6 major rail gateways there.
So you'd think, okay, a company that tied into cross-border trade, they must be feeling the squeeze from trade tensions, right?
That's what you'd naturally assume. Makes sense on paper. You'd expect those international trade wins to be a direct drag.
What?
But what's really striking is their latest earnings report. They actually put up good numbers. And maybe more importantly, they stuck by their financial outlook for the year.
Ah, okay. While others are maybe getting nervous.
Exactly. A lot of other companies in, related fields have been dialing back their expectations. So UNP holding firm. That definitely stands out.
Right. So this is where we get into the how. What's making them potentially different? What's their secret sauce, maybe?
Well, the article points to a few things, and a big one right off the bat is how balanced their freight revenue is.
Balanced, okay. How so?
They've structured things so they're not too reliant on, say, just one type of cargo. It's pretty much split into thirds.
Okay.
You've got bulk, that's your essentials, think grains, coal, renewables, some fertilizer, food. Then industrial metals, chemicals, plastics, energy stuff, forest products.
Gotcha. And the third?
And the third is premium. That's mostly those big intermodal containers, the ones that move easily between ships and trains.
Yeah.
That and also automobiles, auto parts. A bit less, but still significant.
So diversification is key. It's not all eggs in one rail car.
Huh, exactly. Well put.
And if we look at their first quarter numbers for 2025, you can actually see that playing out, can't you?
You really can. Bulk revenue was actually up 1%.
Okay.
Industrial was down just a tiny bit, 1%. But premium, that saw a pretty decent jump, up 5%.
So that mix is clearly helping buffer things. Some areas up, some slightly down.
Precisely. It really highlights the strength of not being tied to just one segment's fortunes. And what's also interesting is how the company's own commentary kind of evolved.
Oh, yeah. Between their earnings calls.
Yeah, between the January call and the more recent April one. In January, they sounded pretty optimistic.
About what specifically?
Mostly about the auto market picking up, and they were seeing good things in domestic intermodal, goods moving just within the U.S.
Okay, but then April.
By April, the tone shifted a bit. They acknowledged the auto sector was looking more vulnerable potentially to tariffs.
Ah, okay. The trade war effect.
Right. And they also flagged an expected slowdown in international intermodal. That directly connects to those global trade issues.
So they're not immune, clearly. They're seeing the shifts. But it sounds like they're adjusting expectations rather than panicking.
That seems to be the case. Their volume forecasts changed too. They expect less food and beverage, petroleum, autos, international containers.
Makes sense.
They see more volume coming from grain, industrial chemicals, plastics, and that domestic intermodal piece.
Interesting. So despite these cross currents, management still sounds confident overall.
They do. The article says their confidence comes from basically the sheer amount of stuff. They're still moving strong carloads, and that diverse mix we talked about, it helps smooth out the bumps.
And they've laid out some financial targets too, haven't they?
Yep. Pretty ambitious ones. They're aiming for earnings per share growth, high single to low double digits, compounded annually over 3 years.
Wow. Yeah.
Plus maintaining industry-leading operating ratio and return on invested capital, or ROIC. They've also got a $3.4 billion capital plan and plan to buy back $4 to $4.5 billion of their own stock.
Okay, hold on. You mentioned their Q and EPS growth was, what, less than 1%?
That's right. Good point.
So hitting that high single or low double-digit annual target for the full year,
Yeah.
they've got some ground to make up in the next few quarters.
Definitely. Something to watch.
Yeah.
But it shows their level of ambition even now.
Let's talk about these competitive advantages the article mentions. It sounds like it goes beyond just the freight mix.
Oh, absolutely. A huge factor is their focus on keeping operating costs low. They consistently brag about, well, maybe highlight is a better word, their operating efficiency.
Which means?
Basically, how much it costs them to run the railroad and move each carload. Lower is better, obviously. And they pair that with strong ROIC.
Right. Return on invested capital. Remind us what that shows again.
It shows how well they're using the money that's been invested in the business, both debt and equity, to actually generate profits. High ROIC means efficient management.
And Union Pacific scores well on both.
Consistently well. The article points out they've kept operating margins that's profit after operating costs in the high 30% to low 40% range for the last decade.
That's impressive.
And ROIC around 14%. That's pretty steady, even while revenue was growing. Revenue took a dip during the pandemic, sure, but it snapped back fast and went past pre-pandemic levels.
It does make you think. Maybe railroads just have a bit more, inherent stability than other transport sectors, like trucking or air freight.
I think that's a fair point. They tend to be less cyclical, less tied to the immediate ups and downs of the economy.
Why is that, do you think?
Well, their main costs, maintaining the track network, labor, even fuel, to some extent, they're somewhat predictable in the shorter term.
Okay.
Plus, they often have long-term contracts, volume commitments with shippers. That creates a more stable demand base, even when the economy slows down.
Right. The article mentioned their revenue drop in 2020 during the pandemic was relatively modest, wasn't it?
Yeah, operating revenue only fell about 10%, and operating income just 8%. In a year like 2020, that shows real resilience compared to many industries.
Okay, so strong core operations, diversified business. What about how they treat shareholders? The article mentions a strong capital return program.
Yes, very strong. They're really committed to sending cash back to investors. Two main ways, dividends and stock buybacks.
And they've been active.
Very. In Q1 2025 alone, they paid out over $800 million in dividends and spent even more, $1.42 billion, buying back their own shares.
Whoa, $1.4 billion in one quarter. That sounds like a lot compared to their full-year target of $4 to $4.5 billion.
It is unusually high for a single quarter. The article specifically notes they made an extra $220 million in open market purchases in Q1.
Why the extra push?
Management explicitly said it was because they saw very attractive share prices.
So basically, management is putting the company's money where its mouth is, saying, even with these trade concerns, we think our stock is cheap right now.
Exactly. It's a real signal of confidence from the inside.
And they can afford to do this, buying back shares while paying dividends.
Seems so. Their dividend payout ratio, the percentage of earnings paid out as dividends, is consistently under 50%.
Which leaves plenty left over.
Right. Plenty of room for those buybacks without putting a strain on their finances. And another interesting point, because they keep raising the dividend while the stock price hasn't, soared, the dividend yield, what you get relative to the price, has actually climbed up to around 2.5%.
Which is pretty decent.
Decent yield, yeah. And with earnings growing, their price-to-earnings ratio, the PE, has dipped below 20. Many would see that as good value for a top-tier railroad.
Okay, so let's try and wrap this up for someone thinking about investing. What's the overall picture here?
I think the picture is a company led by management that seems pretty confident it can handle or pass on tariff costs. A company with a proven history of performing relatively well, even in tough economic times. Remember that modest dip in 2020?
Right.
And because of the dividends and buybacks, it looks like potentially a solid option if you're an investor looking for some reliable income, maybe some stability when the market feels choppy.
That sums it up well. No company's totally bulletproof, of course.
No, never. Especially not with broad economic shifts or trade wars.
But Union Pacific seems to have built in quite a few shock absorbers. That mix, the efficiency, the shareholder returns, it positions them to potentially handle these trade issues better than many others might.
Yeah, based on this analysis, that seems to be the case. Those core strengths really shine through.
Okay, so here's the main takeaway for you listening. Yeah, trade wars are tough on transportation, we know that. But Union Pacific, it's showing some real resilience.
Definitely.
And it seems to come down to that powerful mix. Diverse business, running things efficiently, and making sure to return capital to shareholders.
That's the core of it.
Right. And so that leaves us with a final thought, something for you to chew on. If Union Pacific can navigate these tricky waters, despite looking vulnerable on the surface, well, it makes you wonder, doesn't it?
I wonder what.
What other sectors, ones that maybe seem exposed right now, might actually have some hidden strengths, some overlooked opportunities if you dig a bit deeper.
A good question.
And maybe think about what metrics, beyond just the headlines about revenue or trade impacts, can give you a better feel for a company's real long-term strength in this constantly changing global picture. Something to think about. Thanks for joining us for this deep dive.